Cathie Wood has issued a warning that a coming shift in the stock market from value stocks to innovation and growth stocks could cost investors billions in potential earnings.
What keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. We believed that our portfolios would deliver a compound annual rate of return of 42%. So that's 42% over 5 years. That's more than a quintupling.
And with some investors worried over rising inflation and Fed Chairman Jerome Powell changing his tune on inflation being transitory, Cathie expects there to be a huge divergence in performance between value stocks, or so-called recovery stocks that performed well in 2021, and what used to be called stay-at-home stocks, but are now being called digitalization businesses. So hey everyone, and welcome to FinTech. And in this video, I'm going to be looking at the stock market from the perspective of the innovation stocks and the recovery stocks, comparing how each has performed over the past several years, looking at how each will likely perform going forward depending on what we see from inflation, and look at the perspective of celebrity investors like Cathie Wood, Michael Burry of The Big Short, and Fed Chairman Jerome Powell. So we'll start by talking about how we got to where we are today, right after we talk about DataCamp, the sponsor of this video. DataCamp is a platform that lets anyone, from a beginner to a pro, develop new data skills and get a leg up professionally. When you log on to their site using the link in the description, you can quickly choose from over 350 data science courses, depending on your current level of skill. And if you're not sure what that is, you can take a free assessment to get personalized learning recommendations. For example, I looked into this course on doing machine learning in Python for a possible future video using AI in the stock market. I liked the fact that you could view the whole course's table of contents and skip around if you wanted, and that it had a live coding engine for you to practice in real time. Plus, the whole thing is gamified and you can earn XP as you go, helping you stay motivated with finishing the course so you can actually develop the skills that will help you get ahead. And when you use the link in the description below, you can check out the first chapter of any DataCamp course for free to see if you like it. So you've got nothing to lose, and you might as well see if any of the courses there look interesting to you. And now let's get back into the situation with the stock market. The story of how we got to where we are today, with growth stocks growing unbelievably fast, doubling or tripling in a matter of months, only for them to crash 50% later. Or value stocks like airlines falling off a cliff in a matter of weeks a few years ago, only to just now start to recover to their pre-pandemic levels. We actually have to go back farther than you might think, all the way back to the Great Recession. The housing collapse of 2008 kicked off a chain of events that would trigger one of the greatest economic recessions of all time, along with a massive sell-off in the broader stock market. But out of this destruction, we also saw the longest bull market run in history, carried by huge new innovations out of Silicon Valley that changed how we watch movies, eat food, and even interact with each other. We even saw the rise of the first trillion-dollar market cap stocks, again coming from companies primarily involved in new innovative technologies like Apple, Google, and Tesla. We also saw the advent of high-growth software-as-a-service companies that I like to invest in. Companies that locked in customers with monthly or yearly subscriptions that made them much more likely to maintain previously unheard-of growth rates for years at a time. Then in the beginning of 2020, everything changed. The start of the new decade brought with it the COVID pandemic, and overnight the entire world economy shifted toward remote working and digital communications. Stocks like Zoom shot up 700% overnight as these new stay-at-home stocks took over the news. But over time, people adjusted to the new environment. Restaurants reopened for business, cruise ships started running, people started flying on airplanes again, and a different class of companies started getting attention: recovery stocks. These stocks, which had been sorely beat down by the lack of travel and outside human interaction, looked relatively cheap compared to high-flying software-as-a-service stocks in 2021. So they started to generate more interest as lockdowns eased. But even amidst these larger trends, we saw some pretty crazy stuff happening in the market throughout 2021. We saw GameStop explode in price as retail investors on Reddit's Wall Street Bets used the power of social media to rally against institutional investors, trying to cause short squeezes and take money away from Wall Street. We also saw the rise of AMC, Bitcoin, Dogecoin, Shiba Coin, all different avenues where people with relatively little effort became millionaires overnight. And this has led some investors like Michael Burry, the investing genius who correctly predicted the dot-com bubble of the early 2000s and the subprime mortgage crisis that kickstarted the Great Recession, to declare that we are in the greatest speculative bubble of all time in all things by 2 orders of magnitude. And on top of that, we have seen rising prices all over the place due to supply chain issues caused by the pandemic, something which Fed Chairman Jerome Powell dismissed as transitory inflation, meaning it would not affect prices long term even while it hit our wallets in the short term. But despite Powell's assurances, the market reacted as if inflation was here to stay, selling off high growth stocks and moving more toward recovery and value stocks. And by the end of 2021, the Nasdaq, which is an index of technology stocks in the US, ended up underperforming the S&P 500 index for the first time since 2016. And that was the situation leading into the end of last year. But then everything flipped. While we'd been seeing signs all around us for months of prices rising, from lumber being more expensive to oil to Chipotle burritos. Seriously, they raised my burrito price by 13% last year. I'm gonna have to start cutting back from 4 burritos a week to 3. We also saw this in the CPI data, or the Consumer Price Index. This is a measure of the average prices consumers are paying for different goods over time. It includes all kinds of different areas of the economy, from used cars to eggs to gasoline, and the CPI has risen by 6.2% over the past 12 months. Now, at first, Jerome Powell was insistent that these rising prices were caused by temporary supply chain issues, and Cathie Wood agreed, pointing out used cars as just one example. We've seen a historic shortage in used cars on the market in recent months, a phenomenon which has in turn led to soaring prices for those vehicles. But Cathie Wood calls this out as a specific area that could be misleading if we use it to track inflation. She says that maybe part of the reason for the shortage is from more people buying cars to use to avoid mass transit during lockdowns. In this case, the so-called shortage in supply is really just a shift in the inventory of those cars from auto lots and onto people's driveways. And if car makers turn up production to try to offset this, they could accidentally end up creating an oversupply of cars. But at the end of 2021, the Fed chairman changed his mind on inflation, saying inflation is no longer transitory and will be here to stay at least into next year. This actually matched Michael Burry's prediction that software as a service stocks would drop in value, though at least so far he's been less correct on his prediction for cryptos like Bitcoin and Ethereum falling in price. And it went directly against Cathie Wood's prediction.
Then they do have excess inventories if they've scrambled and the consumer does not come. So I think that's going to happen, and I think it will back up into commodity prices as well. That would be the cyclical sources of deflation.
And deflation is obviously the exact opposite of inflation. So now here we are at the start of 2022 with a question on our hands. Will the trend of the last several months, with inflation seemingly increasing and becoming less and less transitory, continue? Or will supply chain issues ease up and we see inflation fall back to previous levels or even approach deflationary levels as Cathie Wood predicted? Well, let's see what would happen to both value and recovery stocks as well as to innovation/growth stocks in either situation, and see how likely each situation is to happen. So starting from the assumption that we are going to see continued inflation, in addition to the rising CPI and evidence of prices rising all around us, we know that inflation in large part can be driven by consumer psychology. If people expect inflation, it will come. And inflation has been front and center in the news for a while, going beyond Fed Chairman Jerome Powell or Treasury Secretary Janet Yellen to US President Joe Biden, who has put a lot of focus on inflation recently, even pressuring large meatpacking companies into lowering prices for consumers. So if this trend continues and we see inflation in the 5 to 10% range over the next year or two, what effect will that have on stocks? Well, it really depends on the type of stock. Growth stocks that are valued based on future earning potential, often relying on loans to keep growing, could face some serious headwinds as their future growth becomes discounted and borrowing becomes more expensive. In this case, companies like Datadog, Cloudflare, Square, and SoFi could all see drops in their price as they have to contend with the new inflationary environment. This follows the general rule of thumb that growth stocks do worse during inflation, but stocks that tend to do better during inflation are value stocks, which investors view as a haven from the cheapening dollar. These value stocks today include many companies that were lumped into the recovery stock category, airlines, energy companies, banking, and manufacturing. Because these stocks have been priced so cheaply compared to growth and innovation stocks over the past 2 years, investors have a reason to rotate out of the technology sector and into these safe havens. And in the first 2 years of a recovery following a recession, value stocks tend to outpace growth by about 24 percentage points, according to data from research affiliates. But what about the flip side? What if inflation is really just an illusion caused by temporary supply chain shortages that will disappear once the shortages clear up? Or what if companies pushing hard to produce more supply right now end up overproducing and putting us into a deflationary economy? Well, less inflation will generally tend to favor more growth-oriented stocks. But also, these same fast-growing tech stocks may be causing deflationary pressures all on their own. According to Cathie Wood, we're seeing secular forces of deflation from technology, AI, genomics, autonomous vehicles. All of these technologies operate on an S-curve of ever-cheapening technology and computation. And each S-curve feeds into the next one. AI training costs, for example, are declining 60% per year. As that permeates different industries, it will lead to cheaper manufacturing, for example, which will lead to cheaper autonomous vehicles. Or it could result in productivity increasing for white-collar workers faster than wages. While we might think of technology in terms of tech stocks that always go up in value, when we look at any given piece of technology, it almost always drops in price over time, which is why Cathie Wood says technology is inherently deflationary. Plus, there's the small issue with China currently running an economic experiment to stop their housing boom, which I won't rehash the entire thing here, you can watch my video on that, but basically it could kickstart a deflationary spiral starting in the commodities market, especially considering how much of the world's goods are manufactured in China. So now we live in this weird in-between world where we do see deflationary forces at work, but we also maybe kind of see inflation happening anyway. And no one can seem to agree on what the numbers are actually saying. Heck, even the Fed can't agree with itself on that. But what we do know is that there is a sort of under-the-surface battle going on between recovery stocks and stay-at-home stocks, between value and innovation. And whichever side ends up winning out will likely see huge price appreciation as investors from the other side rotate their money to a different sector. So what am I personally doing to address this issue? Well, I see two bright spots here. Number one, we generally see a stock market rise in the beginning of the year, regardless of which sector you are investing in. This is due to people deploying new money into the market now that the tax year has ended. And the other bright spot is that the market as a whole rises over time. So this entire debate is kind of like playing blackjack at a casino. Only you own the casino. We have the odds tilted in our favor here. Personally, I am more experienced investing in growth, technology, and innovation stocks than I am in, say, value stocks, which is why I talk about them on this channel. And while we may see a cyclical rotation out of these companies in the short term, I know that in the long term, they will be creating massive new value for the world and will hopefully be rewarded by the market for doing so. Basically, I'm saying forget the zero-sum game of who is going to win in the short term and focus on finding companies that are creating new value in the long term. But that's just my opinion, and I'm curious what your position is on this. Do you think Cathie Wood is right and people sitting in value stocks are going to miss out? Or do you think Michael Burry is right and growth stocks are way overvalued and inflation will ultimately favor value stocks? Let me know in the comments. Don't forget to like and subscribe, and I'll see you next time.